But on a separate note, we got to talk about Microsoft, Amazon.com, Alphabet, and Meta platforms all alone could combine for capital expenditures of $356 billion this year. That's up 56%. This comes from Bank of America. That compares with $904 billion, up 5% for the rest of the S&P 500. Again, we always give you solid numbers on the Smart Investing Show. It's not like hype. It's not like, oh, this is... No, we give you solid numbers to kind of make sense for you.
And if my math is just quick math right on that, that's 4 companies essentially, 1, 2, 3, 4, accounting for about 25% of all the CapEx in the S&P 500.
Yeah.
And this is just something when I look at it, again, there will be winners in AI. And I'm going to tell people we will be wrong because we're saying we don't want to invest in this space because I don't know who the winners will be.
Right.
But we're going to tell you, well, maybe that one's not a winner. And it will be a winner, right? There's going to be winners that we're not predicting because good luck doing that. But the problem is I just can't foresee who's going to win here because, again, using this example, if you're using a 5 to 6 year useful life for these chips, well, then that would hurt NVIDIA because you wouldn't need to replace the chips for 5 to 6 years. Point. So after this build out is done, maybe a year or two, well, then what is going to happen to NVIDIA chips for, let's say, a 2 to 3 year period? Now, if it's the other side of the coin and you need to replace the chips every year, that's great for NVIDIA. But these hyperscalers, that then means they are now having to spend $300 billion, let's say, on capital expenditures every single year. And a lot of times these tech companies, they've gotten premium valuations because they aren't CapEx heavy. And when you talk about now you're stacking $300 billion every single year, now that depreciation is going to start mounting at a very, very quick rate, and your earnings are going to have a hard time growing. I mean, it's just when you start logically thinking about it, it's like not everybody can win.
It's a snowball going up the hill because those expenses will increase. You got to write off the CapEx because you did that. Then you can buy new chips that are more expensive, and probably you won't be able to do a 5 or 6 year life on those. Like, no, the CPA should say, no, you get 1 to 2 years. What? That's going to be a big write-off. Well, they're coming. The train is coming to a difficult period, and it could be. It's not going to be tomorrow, but it's going to be longer term. And this could cause and that's why he mentioned the tech boom and bust. Things happen, and nothing goes on great forever, and that's why we look at the numbers because, and it doesn't mean we know the exact date, nope, but we know when things don't look right.
And I do have a note. I want to write a post about the Nifty 50 because a lot of times people say, oh, it's not like the tech boom because these companies actually have cash flow and earnings. Well, the Nifty 50, that is going to be, I think, a great history lesson for people to look back on because that was your Gillettes, your companies that weren't super exciting, producing strong cash flow, that they got way overpriced. I think what we're in right now is a combination of the Nifty 50 and the tech boom.
And I think very similar things are said. Like, oh, don't worry about it. Just buy it. Just buy it. Goes down, buy it. Goes down, buy it. Goes up, buy it.
They were the forever stocks.
Yeah, forever stocks. And learned a lesson in 73, 74 from that. So, again, we're trying to be ahead of the curve for you, make you a smarter investor.